method, right? So estimating the bad debt expense, the acceptable methods. We said there are two ways. I either do it a percentage of the sales or a percentage of the accounts receivable. Okay? Actually, this should not be sales. Okay? Who can make this correct? There's something not accurate in here. Who can make it here? I'll add 3 marks if you make this correct now. Whoever tells me what word I need to put in here to make it accurate, okay, will get 3 marks. You remind me that your overall is 90 or 80, I'll make it 3, 83, 93, 53, 23. One word, I want one word, and you don't guess. You tell me this, and you tell me why. And don't Google it or whatever. I know if you Google. And you have 5 more seconds. 4, 3, 2, 1. You lost. Make sense? Are you sleeping, guys?
We're thinking,
Huh?
Mr. Adli.
Are you
We're
are you sleeping? Oh, you're
No, we're
thinking.
thinking, Mr. Adli. But unfortunately, it didn't work.
Yeah. See, I just added the word in here. Okay? Meaning, I have sales, correct? So I received cash, 1,000. Sales, 1,000. Okay? I have accounts receivable, 1,000, and sales, let's say 10,000. So it's not the same transaction I'm talking about. Okay? And let's make this as 16. 16. Okay? So what is my total sales? I have sales 16,000, and I have sales 10,000.
26.
26. Now, why did I add credit sales? Do I have to worry about the 16,000? I will not get it. I'm talking about bad debts. I'm talking about money I would not collect. Right? So here, you see here, I received cash for this sale. Is there a risk in it? Is there a risk that I would not get the 16,000? No, I already received it. Where is the risk from the 26? There is 10,000 risk that I would not be collected. Not all the sales, right? So usually we calculate the percentage from the credit sales only, not all sales. Okay? So you pay attention in the question. Sometimes it says our credit sales are this much. So right away I'm giving the credit sales. So I use this much. In some cases, it will tell you that our sales are this much, and 5% of it is credit. So I don't have to worry about all this amount. It's only 5% of it is credit. That is at risk. Okay, so you pay attention to this. Some questions would give you credit sales, so use it as it is by the percentage. Some will tell you that this is our overall sales. This much of it is credit. So I have to worry about that percentage of the credit. Then I multiply it by the percentage of that sales. Okay, not from my total sales, but from my credit sales. And the second method is from all my accounts receivable. Okay. So percent of sales approach, we said it's also referred as the income statement. Why income statement? Because in my income statement, I have sales, I have returns and allowances, and after subtracted them, it will give me my net sales, right? Because this is the income I'm making. So that's the income statement. Now my income is from sales. So that's why it's called the income statement approach. Based on the idea that a percentage of a company, see here, is mentioned in here. You see, here it says credit sales. So it's not all sales. All sales includes cash. I receive that cash. There is no risk in that part of my sales. Only my credit sales part of it is uncollectible. Okay? And the primary focus is on matching bad debt expense with the credit sales. So, straightforward thing. Okay? Your current period sales. Okay? And what is the percentage? Now, don't start, okay, where do I get the percentage? The percentage is given to you. The percentage is decided by the company, by the organization. 1%, 2%, 5%, 10%, whatever they decide. Based on what?
Just go.
Based on their customers, based on past year's experience, based on they decide, the company decides that percentage will be given to you. You don't find the percent, okay, as given to you. Again, let's see here. Current period credit sales. That's better. Okay, so I multiply the credit sales of this period by the percentage I have. That would give me the estimate of the bad debt expense. Okay, so an example. Okay, Musicland has credit sales. See, it says sales, so I don't have to worry. I'll use the 400,000. Okay. Estimates. See, this is given to you. 0.6% of those sales will not be collectible. Estimate the bad debt expense. Okay, so it will be 2,400 calculated as 400,000 multiplied by the percentage. So right away, my credit sales multiplied by the percentage estimated, and that would give you this. So this is my what? My estimated, see here, bad debt expense allowance. This is estimated, just like when we did in the first. We said we are estimating in advance whatever we have. We thought that I would not be collecting from my customers. So bad debt expense, we said it's an expense. It is going to be debit, whatever the amount I estimated, and that's the allowance where I'm going to write off all the what? Bad debts. Okay.
Accounting?
Now, this was the sales.
Yeah.
Which sales?
Studying.
Credit sales. If here it says 500,000, okay, and 80% of it is credit, then I have to multiply 80 by 500,000. That will give me 400,000, and then I multiply by the 6. If it's given to you directly as credit sales, this is what you're using directly. Another one is a percent of the accounts receivable. Okay? So in general, all accounts receivable, which is very, very similar to sales, right? So people owe me money for sales or for anything else. Okay? Part of it, a percent of it is uncollectible. Okay? So instead of credit sales, by the percentage, I'm doing what? Accounts receivable by the percent. That's it. Same thing. Okay? Credit sales or income statement, I use the credit sales. Accounts receivable, okay? I'm using the accounts receivable by the percentage. Straightforward, I'm multiplying by the percentage. Okay? Now, the thing also brought is that not all the accounts receivable should be treated the same way. Okay? Meaning, I have somebody who purchased from me this week. Or forgot the starting week, last week. I have somebody purchased from me last month. Purchase, I mean, I have accounts receivable from last week. I have accounts receivable from last month. I have accounts receivable from the last 60 days. I have accounts receivable from the last 90 days and over 90 days. Okay? I shouldn't worry about this as much about this, as much about this, as much about this, as much about this, right? I am more likely not to get this, less likely not to get this, less likely not to get this, less likely not to get this. This is, I likely will have it. Just last week, I don't know, like, okay, it's not even due yet. So, based on this idea, the accounts receivable, okay, will be what will be grouped into how much time they have been there, how old they are, okay? And for each group of those, I will make a percentage and then add it all together. In the sales method, I took credit sales, by the percentage. And I can do the same thing with accounts receivable, right? But if it's asking you to do the aging method, then I have to classify the accounts receivable based on what? Based on their age. Okay? This is an example. Let's look at it here. Receivables for the decor were classified as follows. So these are balances. So the current accounts receivable. Okay? I counted them at 37,000 in them. So these, there is no past due days. Here, between a day and 30, between 1 day and a month, past the due date. Past the due date, I have 6,500 of it. I have 31 to 60 days past the due date. This much. Between 2 and 3 months, this much. And I have past the due dates by 3 months, 1,000. Okay? So total is 49,900. I'm not going to come and multiply this by 10%. Why? Because like I said, the risk related to these accounts, these debts, okay, is not the same, right? This is a higher risk. This is less. This is less. This is less. There is no risk in here. Make sense? So there'll be a different percentage for each one of those accounts receivable. Meaning, where is it? Okay. It went, disappeared. Okay, here. See here? For this, I put 2%. Estimated. Don't tell me where did we get this from. We are estimating this. Okay? You're not calculating it, whatever is given to you. For this, 5%. This, 10%, 25%, 40%. Based on what? Based on what is the risk of being unable to collect them. So then I multiply 3,700 by the 2%, $740. 6,500 by 5%, this much. This by 10%, this by 25%, this by 40%. And then I add them together. This is my estimate. Okay? So I'm classifying my accounts receivable according to their age. And I'm assigning different percentage for each age group or category or whatever. And I'm using that percentage and then totaling all this to come up with the total estimate. Clear, guys? Is this clear? People.
How do you determine what percentage for what period of time?
Less. I said this is the company's issue. The company decides the percentage. It's not, it's company's experience. For me, I would give this, for example, 1 or even 0. This I would give 3. You give this 15. I give it 17, whatever. Guys, this is estimated by the company given to you in the question.
Mr. Adley,
Yes.
are these adjustments are being done at the end of the accounting period?
What's that, Narisa?
These are being done after the accounting, like during the what do you call that? The closing period.
Yes,
Like,
this is what we do. Yes.
okay.
Because this is when it comes to, okay, I have this much of pending credits, being the first method or the second method. I have so much credit sales, right? And I have this much of accounts receivables at the end.
Mhm.
So I have to account for it. I have to calculate something as this is my estimate that this much of my money from this period will not be collected.
So meaning all the accounts receivable, let's say for example, from 2023 are now being transferred to like what do you call that, bad
No, not all of them.
allowances,
No,
right?
because see, guys, the end of year is just a flow. We have certain accounts, if you remember, those certain accounts. We did what? We had to close them. Do you remember?
Yeah. Yes.
We closed the revenues, we closed the expenses, we closed the withdrawals into income summary, and we closed that into the capital. But all the other accounts, like somebody purchased from me on the 30th of December, right? And then 31st and 30, on the 1st I was closed, and then I reopened whatever. So it's just a flow. Like that account is just, he still has 2 weeks to pay me. So it's an ongoing process. But for the sake of my books, because I have to close my books, I have to estimate something. This expense, this would go off my what? of my income statement,
Mm-hmm.
right? So when I put it as an expense at the end of the year, I close my books, I kind of estimated how much of my collectibles would not be collected. So I kind of tried to show a better or more accurate income statement. That's the purpose of it.
Mm-hmm. Mm-hmm.
Okay? This you will see in the questions, guys. So unadjusted balance of the allowance is that 200. The previous computation showed me 2290. This is from here, right? So how do we find out the number in here? You will ask to find out the number, right? You subtract this. If you have unadjusted balance, and this is the adjusted balance, this is what you calculated. Okay, if you have an adjusted balance, you subtract it, you see, or you add it. If it's here, you add, if you here, you subtract, and then you get your actual number. Okay, guys, when you see it in the assignment, we'll bring it up if it's a bit confusing. Okay, now take a 5 minutes to break before we go through this, okay? Because this is another topic, another calculation. So just 5 minutes. I will start exactly at 15, not 5 then.